of the Cayman Islands.
Live from Radio Cayman Studio, this is
Money Sense, bringing an informed financial perspective to the Cayman community.
A very good morning and warm welcome once again to Money Sense. I'm Simon Caudry and I am delighted to be rejoined this morning by the Emil Kalinowski. Emil, a very good morning to you.
It's an institution, the Emil Kalinowski.
Well, we started it last time and I think it's only fair to continue. The more we say it, the more others will agree.
Let's do it. I'm excited. I can't wait. I'm so excited. It's just crazy and wild and I want it.
If you're watching this on YouTube, you will see levels of excitement across Emil's face that border on the insane.
I was released from the hospital to do this show for 30 minutes. So
you're not one of the 14 that had to quarantine then?
No, it's psychiatric hospital.
Okay. Now, you're here this morning to prove, and these are deep and big shoes to fill, that not all sequels failed to live up to the original. I mean, you've seen Die Hard, Rambo, Rocky, Star Wars. Not all sequels are as good as the original.
That's right.
So,
Rambo. All right, well, we should stick to finance.
Okay,
this would be a great show. Susan, do we have any time in the schedule for a sequel movie review show?
Yes.
We'll bring it up with management. Thank you, Susan.
So here we are. We're back on Money Sense. Now, 2 weeks ago, your thought process was cut off by the intricacies of time. And you said something in that show which has stuck with me for 2 weeks. I haven't slept well because of it. You said that we could be in the midst of the first ever global bubble. Let's just revisit what you meant by that before we get into some more profound and other profound areas of finance.
Well, I believe if people were asked, if you were to stop a stranger on the street and walk up to them and say, "Dear sir, dear ma'am, what is a financial bubble?" there would be several reactions. But eventually I think you would get to one where they would say, well, the dot-com bubble of the 2000s, the housing bubble of 2008. But if we reach back, I think we've all heard of the tulip mania bubble from Holland, although there's been research recently by Miss Anne Goldgar that suggests that it was completely exaggerated, the nature of the financial mania, such as it was.
Around the tulip bubble.
Yeah, so maybe it wasn't as bad for the tulip mania, but we have this idea, tulip mania. Where did tulip mania happen? Holland. That's it. It didn't happen in London. It didn't happen in Frankfurt. Then one of the most amazing bubbles in history was the Mississippi bubble. That happened in 1720 in Paris and affected the surrounding lowland countries.
The Mississippi bubble happened in Paris?
Well, it was an investment in Mississippi.
I see. Okay.
Out of Paris.
I was going to be doubting your geography skills for a moment there.
Not to be outdone, speaking of geography, the British, seeing that the French were having a wonderful time with a financial mania, said, why don't we have our own? And they had the South Sea bubble at almost the exact same time, famously capturing Isaac Newton, who said, I can predict the motion of the stars, but not the madness of men, because he lost money. He invested in the bubble and he lost money. But that was in London. And then the dot-com bubble, that was if you were an American, if you had access to American stocks. So what I'm trying to say is these are localized bubbles, but now with Bitcoin, and that was the point of our discussion, Bitcoin, by definition, is decentralized. It's worldwide. Anyone with a computer can participate. Everyone, so many, more people than ever have heard of this financial product, this money, and now they can participate. And I believe it be the very first worldwide bubble. And as proof, I would show that if you measure the price appreciation of all of those bubbles I mentioned, plus a few more from 3 years prior to the peak to the peak, you'll have some incredible ramps, logarithmic, exponential curves, hockey curves of prices, right? The 3 years away, and it's gaining momentum, and then like a runaway train, it reaches the peak and runs off the tracks, and it's this incredible crash. Well, if you put all those bubbles on the same time scale, would you believe it that Bitcoin, the 2018 peak, was the greatest 3-year price appreciation of any recorded bubble? And I think it's no coincidence.
That's the 2018 peak.
Yes.
We're, shall we say, beyond that.
Well, perhaps. I mean, the price is higher,
Yeah.
but it would be a manner of measuring, you know,
it's the way
where
that it
were we
went up
3
in the 3
years
years,
ago.
okay.
But I would not be surprised. And yes, I believe it was the greatest bubble in recorded human history, probably because we could all participate in it. People in Venezuela, Argentina, Wall Street, Lombard Street, Cayman Islands.
So that's a question that I suppose touches a little bit on psychology in some respects, which is if a
You're
bubble
bringing up
is...
the psychiatric hospital again.
Yeah, quite.
It's very impolite. Okay.
Well, it's a sharing experience, this show. But if a bubble is localized, by definition, the quantum of buyers associated with it, we'll go back to some base economics, prices rise because supply is insufficient to meet demand. If a bubble is localized, the quantum of supply is what it is, but the quantum of buyers is limited by the geography in which it happens. If a bubble is global in nature and the supply is fixed of the same magnitude, but the quantum of buyers is, for intents and purposes, unlimited. I mean, obviously there is a population limit on the Earth, but practically speaking, 8 billion, it's going to take a while for 8 billion people to get around to it. You're saying that as we expand, as technology expands, it creates the potential for even bigger bubbles by the definition of being able to expand the quantum of humanity that can participate. Is that?
Yes, I think that's very well put. And I heard a fabulous quote once that bubbles can go to unimaginable heights and then double from there. So I think we are at that moment in human globalization where so many more people can participate, and especially with Bitcoin. That's the difference, is that Bitcoin, if you have a computer, you can participate. Whereas with stocks, you need a brokerage account. You need to be identified, measured, mapped, and you have to submit information. With Bitcoin, it's much easier to participate.
And it's not to say that bubbles are necessarily bad things for people to speculate in.
Mm-hmm.
They can be. If you buy at the top and you don't get out, then you could lose a huge amount of money. But on the way up, you can make a lot of money.
And nor is it, because I want to stop the crowds, the masses that are now getting in their cars, driving down to the studio to protest. I want them to stop. We're not saying that Bitcoin is bad.
Well, we might be.
Well, Simon is. Please see him after the show. But the bubble is a human phenomenon. Gold was in a bubble.
Yeah.
Technology stocks were in a bubble, but those technology stocks are still around. It's not... Do you know what I'm saying? It's don't throw the baby out with the bathtub. How does that phrase go, Simon?
Bathwater.
Help me.
I think you'd have to be quite strong to move the bathtub.
I think you're wrong. I think it's you throw out the whole clawfoot porcelain freestanding tub.
What about
but
the tiles?
we'll move on.
Yes, quite. I think your point you're making there, then, if I understand it correctly, is that take the analogy, during the dot-com boom, even companies like Microsoft saw their share prices reach stratospheric levels. But at the end of the 10-year period afterwards, Microsoft was still around, and it took some time to get back to those stratospheric levels, but it had earnings and it had profits and it had businesses and it had products that people used and bought. And so something fundamental underneath it was still generating usefulness. And that could well be the same argument for Bitcoin and for the cryptography landscape. There could still be fundamental usefulness associated with the product. You're saying that there's a distinction between the practical usefulness and the price of that product. Those things do not necessarily need to move in tandem.
That's right. That's right.
Fair enough. And we can talk about that in the context of stock markets as well in a short while. But perhaps before we do, though, we also 2 weeks ago touched on the inflation story and we touched on the prospects for economic growth, I think you had said that the economic recovery had already stopped in some respects, insofar as the growth rate had been. We were going to be well past the peak in the recovery growth rate. Now you're someone who has a particular passion for rocks and things in the ground, and perhaps you could sort of give us a sense of where those things, the commodity space, is leaning in terms of indicating what's going on in the world and what might be going on what might therefore happen in the economy, because sometimes those can be leading indicators of future excitement or future concern.
That's right. The commodity markets are indicating recovery, reflation, and excitement. Possibly that the economy is getting better and it will continue to get better. I suppose there's also a possibility that they're indicating, that's one interpretation. The other interpretation is that they're indicating that there are some supply constraints and or demand surges and or supply chain disruptions because of the pandemic and the reactions by society and government to them. So it's mixed message. Is this a temporary increase in prices in copper, oil, etc., or that indicates excitement for the future, or is it just a reaction to the pandemic? Good people could disagree. I'm leaning towards that this is a supply chain demand issue that will not persist. We're not in a commodity boom cycle at this moment because the economy is struggling so much. And if we got into the weeds, if we dove into the thicket, into the heath, we could talk about what do future prices compared to current prices in commodities suggest. And it seems to me that they're suggesting that markets are saying, don't bring on any more supply. So, we're not too confident about the future.
Talk to me a little bit more about that, because you said something there which is in some respects quite an easy concept to grapple with once it's understood, but intuitively it's quite a difficult one. You're talking about what current prices and future prices. Just paint the picture of what that means.
Well, there are these things, futures markets, where you can make an arrangement to deliver oil sometime in the future. And so if you have oil or copper right now, you can store it and then sell it in the future. So you've agreed, I'll sell it at this price in the future. And that works out for me if you consider the storage costs compared to today's price. So I will store this commodity and deliver it later.
The storage costs are low, therefore if it's priced at $100 and today's price is $80 and storage cost is $10, the maths means let's store it. It will cost me $90, but I'll be able to sell it for $100. Winner. Bargain.
And what you would expect, though, for a healthy economy would be consumers saying, don't bother storing it. We need it now. We're investing now. The economy's taking off. We'll pay you more now than we would pay you in the future. And you don't see that in oil, for example. What you see is that people are saying, why don't you hold on to this? We don't need it right now. Put it away. And that would be indicative of producers not being consumers not being very excited about the future. And I keep saying producers because there's a couple of examples where you see strong retail consumption in the United States, but you don't see the corresponding surge in production, in manufacturing. It seems like producers are hesitant.
Producers could also be forced to be hesitant in a sense by the fact that they're not able to get the labour supply that they need to ramp up production because of restrictions on social distancing or being able to go back to workforces in certain countries. So that could be
Absolutely. That could be it. It could also be it that we've seen this story 3 times before. We've seen 3 global or regional slowdowns in the last 14 years, and they're saying every time the recovery began, it didn't last too long.
And there's an indicator or a signal here that would be quite familiar or unpleasantly familiar to people in Cayman, which is lumber prices. People in Cayman are very familiar. If you're buying a house, building a house, doing something on a house, doing anything at the home centres, that the cost of everything in those centres has gone up. Price of wood has gone or went through the roof. It went from a reasonable price, it almost tripled and quadrupled in a very short period of time. But then, when people were at the most concerned about the supply and most concerned about the price and said, well, this will decimate the economy, this is unsustainable, this will kill the construction industry, as quickly as it went up, the price started to fall dramatically, indicating to your point that actually there isn't necessarily a underlying supply issue. There might be a translation issue of the raw material into a product form that people are looking for, but that's most often a temporary blip caused by a temporary supply chain disruption as opposed to a fundamental imbalance between supply and demand.
Very quickly, because I know we have to go to a commercial. Commodity markets, despite their use, they straddle financial and real economy, but they are not the best leading indicators. And a great example of this was the rise in oil prices in the middle of 2008, right on the cusp of the world's biggest financial crisis since the Great Depression. So there's something to be learned, but we need to look at other markets for confirmation that of the good news, theoretically, that commodity markets might be saying with rising prices.
Okay, well, let's retouch on that in about a minute or so after we've had a quick break. Do rejoin us again for Money Sense with Emil.
Radio Cayman, maintaining the innovation.
On a daily basis, making it easy to connect with you, our listeners. Add us to WhatsApp today, 925-3261. That's 925-3261.
Radio Cayman.
Send a text or voice note.
Can I send a request, please?
You don't really have to ask us. Just send a request.
This is a shout out to my ex.
Radio Cayman, the voice of the Cayman Islands.
Radio Cayman, maintaining the innovation.
This is
Money Sense, bringing an informed financial perspective to the Cayman community. Brought to you by the CFA Society Cayman Islands.
And now, more Money Sense.
Welcome back to Money Sense. We are joined once again by the Emil Kalinowski, who is, what's the word I'm looking for? Prognosticating? Perambulating? Any other words beginning with P that we can... No, I've flummoxed you. Okay, he's talking on commodities, talking on the economy. And just before we went into a break, we talked about supply chain disruptions. We touched on oil. I mentioned lumber. What about other commodities? What about some of the metal space? Are there things that we can be learning from there? Are there other signals that are perhaps being percolated through the ether that we should be listening to or contemplating upon?
Prestidigitation. That's magic. That's the other P word that I thought we could go with.
As he looks that up on Google.
Prestidigitation. Well, okay, so I said that there are two possibilities. One, commodity prices are rising because producers and consumers believe the economic recovery has been sustained, has caught, and will continue. Another option, we are experiencing supply chain disruptions. Here's the third option I didn't mention before, and that is the excitement around green energy or new economy or environmentally friendly energy. So, and that would be driven by politics and policies. So, with the election of President Trump, it now seems that the advanced economies are in alignment with pursuing green energy, green, new, environmentally friendly power.
You meant Biden, I presume.
Isn't that what I said?
I think you said the other fellow.
That may have been a faux pas. Maybe I wanted Trump to win.
Or a Freudian
Well, it's
slip.
come out now.
Yes.
Yes. How embarrassing. How much... Can we
Shall
go off the air? Or is this not... It's not live, is this...
No, we talked about that last time. People aren't listening. It's fine.
So, yes, that's what I meant to say. Oh, Trump. Okay, no, continuing. Let's see. Biden won, and so now the advanced economies are in alignment. And that's a political decision that the governments will subsidize windmills, hydroelectric power, solar panels, nuclear power. And believe it or not, all of those things take a lot of different interesting metals to utilize, to fabricate. And then, for example, when you got electric vehicles, let's say you need all sorts of power chargers, and that's a lot of copper. So we may also be seeing those metals that are quote-unquote green reacting to the inevitable, quote-unquote, the imminent, quote-unquote, I don't know how inevitable and how imminent, pursuit by governments. What if the United States announced a Green New Deal? Well, that would be a lot of metal. So perhaps that's what we're also seeing.
And without wanting to pour any cold water on a environmentalist excitement, there is a degree of irony about considering new battery technology and such like green, given some of the extractive methods to extract the metals that are needed in tiny quantities even for these technologies are incredibly polluting and incredibly toxic and incredibly destructive. So that's something that often isn't talked about, and this is, again, I have no problem at all with the pathway of electrifying economies, but there are hidden costs which typically aren't seen on the general news shows. I mean, those people say, well, capturing solar is far more efficient than burning diesel. That's unambiguously true, but the costs of making environmentally, some of these solar panels aren't as clean as people might otherwise be thinking them of as being.
The wind farms are killing fields for birds. That's another not very environmentally friendly consequence. So yes, you have to take into consideration all of these aspects. Do our advanced economy political leaders do this? I don't know. But it seems that they're very excited, very gung-ho in pursuing this, although I haven't heard any announcements. So perhaps it is bubblish, overwrought, too excited, too much right now with the metals.
Well, I think the panic in the political sphere is clearly that the 1.5 degree target is unlikely to be reached, and therefore there's more hot air being emanated by politicians to try and solve that without actually grappling with the, fundamentally from an economist's perspective, right way of doing it, which is to impose a tax on the externality that's caused. Instead, let's talk about everything other than solving it the pure way that an economist would. But that's
another show.
That's a digression of anguish and anger that will only
2 new shows we've discovered.
Exactly. Yes. Well, yes. What was the first one? It was about sequels.
Movie sequels, and the second one will be how would an economist run a society by Simon Cawdrey.
Well, it would be simpler.
Okay.
Yes. Let's sort of go back to something that was discussed in the first part of the show. You had talked about, and here I may, if you'll permit me, extemporate for a moment or 3, because you talked about bubbles, and I thought it would be quite interesting, and so I did a little research. Now, just a little. I don't want you to think that I was trying to copy you too much by working hard and studying things too deeply. But I did a little bit of research to try and put some context here, because you talked about there being a potential disconnect over a period of time between what the price of something is and what its intrinsic value is. And we have talked about that in a whole variety of concepts, from tulips to Mississippis. Stock markets are prone to the same sort of thing. You mentioned that when you came to talk about the dot-com boom. And it's interesting you brought up the dot-com boom, because I did the research I did was on valuations, just looking very basically at, say, the S&P 500, so the 500 broadly largest companies in the US. And while it's true to say that stock prices generally don't always follow earnings, it's also true to say that there's a fundamental connection over the long run between those two factors. But if I may, just talk about what a valuation is. Everyone uses the word valuation, but it's often quite difficult to understand. People say, oh, this thing's got a 20 times price earnings. Well, what the devil does that really mean? What it means in principle, if something's got a 20 times price earnings, is if it pays out its earnings as dividend, you'll get your investment back in 20 years' time. Now, that's quite a long time period for most people to get their earnings back. It means if I give a company $100, I will get $100 in earnings back in 20 years' time, all other things being equal. That means you've made no profit. That means in year 21 you start to make a profit. In year 22, 23, 24 you start to build up profit, but it still takes quite a long time. So when we inure ourselves to a valuation of 15 or 20 times earnings as being acceptable, that's quite an aggressive length of time. But people do. And so if you go back to the 1960s, let me get my research here, the average ratio was between 15 and 20 times. Then, of course, the 1970s happened. It dropped between 7 and 12 times. Then the 80s, we had Reagan, Thatcher, Perestroika, Culture Club, which I know you're a fan of, the Berlin Wall. Yes, indeed. And in party time, the world looked better and the valuation multiples increased to 15 to 20 times. Then the 90s, technology, microchips, Emil joined university and there was a dawning new light in society. Then valuations rose rose to 15 to 20 times earnings, up to 30 times at the peak, before collapsing, of course, to 15. And then we hit the corona times. Now, what's important to say is that valuations don't necessarily reflect what the valuation is in 1 year, because weird things happen. You could have aliens visit the Earth and everyone stop what they're doing, talk to these aliens and say, well, this is fabulous, enjoy a nice conversation and stop buying stuff.
Not again.
Well, indeed. That happened, what, Peru? Are we? No, kidding. But strange things do happen, causing any 1 year's valuations to go out of whack. So then what you do, well, let's look at the next year. Let's forecast forward. Because right now, earnings are a little bit extraordinary in terms of they're unusually low, they're depressed. But future earnings, 2021, 2022, should have been basically put the coronavirus pandemic behind us. And yet, even when you look at that, the future earnings are based on 20 times 2022 earnings numbers. But before the pandemic, for the last 30 years, the average of that has been 15 times. So even when you ignore current valuations, you ignore the current discombobulation in earnings, we're still completely out of whack with history. And that causes me, as an investor, some stress, because I say, well, why do I want to buy something that's expensive? Why wouldn't I buy something that's cheap? So clearly in the 1970s, 1980s, pile into something that's very cheap. But why buy something, if you were to cast your mind back to the dot-com boom, would you have bought in late 2000? Almost certainly you would have done, because everyone was. Should you have done? Probably not. And that troubles me as to where we are in the world. So that was my little narrative for the last third of the show. And I just wonder if you have any comments too.
Wonderful, wonderful analysis. And perhaps I'm speechless. Wonderful analysis. There's so many places to go, but we don't have much time. I heard that the most amount of time that you needed before... Oh gosh, I'm just slipping all over. Somebody did a study. I think his name was Jeremy Siegel. He was a professor, and he went back 200 and some years of stock markets, and he saw the most you had to wait before you could make money in any particular combination was 17 years. So that comes right out to what you were saying, the 20, the 15, the 17. So that looks like a reasonable area to kind of for valuations. But maybe the stock market isn't about valuations. Maybe it's about maybe it's a liquid pool of capital that you can put your savings in. I'm talking about large institutions that you know is liquid. And you know won't lose your money, because if you put it in cash, you know it will because of inflation.
So if you've got a scenario where I give you two options. Hey, Emil, it's behind door A, I can guarantee you'll lose 1.5% per year. Emil's looking a little bit, I don't like door A. Behind door B, you might lose 15% in a year, but you might also make 15%. That's, even for an economist, an easy game to play, because the average of those is 0, but when the other one is minus 1.5. So the volatility that the stock market gives you, given the certainty of losses in other asset classes, is probably pushing people to invest in something, even though they know that in reasonable times they probably wouldn't.
And then there's the whole phenomenon of passive investments.
Yep.
And maybe that's what we'll talk about next time.
I think that is a very interesting topic to discuss. Well, with next time comes the sad realization that there well, not the sad realization, but the realization that we are sadly at the end of our time, but the happy news that there will still be a next time. So I was worried about saying the sad realization there will be another show. I didn't mean that. So we have beaten ourselves up against the time deadline. We are already, I think, a smidgen. Oh, no, I've got about 20 seconds to prevaricate a little further. But before we leave, just to thank you, Emil, for rejoining. It's been a pleasure having you on the show and very much enjoyed the conversation.
Thank you very much, Simon. I loved it.
For all our regular listeners, 2 weeks' time will be our next show. Remember, we have a Twitter. We also have an email. That is moneysense at cndw.ky, and at Moneysense Radio is our Twitter. With that, if you have any questions, email or Twitter us on those different things. Otherwise, please do rejoin us in 2 weeks' time for another episode of Money Sense.